If you're holding Iraqi Dinar right now, waiting for that life-changing revaluation, you need to stop everything and listen to this, because a single misstep based on a recent, quiet announcement from the U.S. Treasury could see the IRS take every single dollar of your potential profit, and then some. This isn't just another dinar rumor. This is a concrete, documented shift in policy that fundamentally changes the game for every single U.S.-based investor. And the financial experts and tax attorneys who are actually paying attention are sounding the alarm bells, warning that the traditional advice swirling around the dinar community is not just wrong, but dangerously so, setting up thousands of people for catastrophic financial penalties and even potential legal trouble. The core of this new guidance, which we will break down in brutal detail, revolves around two nightmarish concepts for any investor: ordinary income tax rates and the devastating, often misunderstood, FBAR and FinCEN 114 foreign asset reporting requirements, which, if ignored, carry penalties so severe that they can exceed the value of the foreign currency account itself. So before you dream about what you'll buy after the RV, you need to have a bulletproof plan for how you'll navigate the U.S. government's claim on your money. Because I can guarantee you the Treasury and IRS are not speculating on if the dinar will revalue. They are building a compliance framework to ensure that when it does, they get their share, and they are counting on your ignorance to pay for it. Let's dive deep into the first and most critical pitfall: the difference between capital gains and ordinary income, because getting this wrong could literally cut your profit by more than half overnight. The pervasive myth within the dinar community has always been that any profit from a currency revaluation would be treated as a long-term capital gain, which for most people would mean a tax rate of 15%. And that assumption has fueled countless dreams and calculations. However, the IRS has very specific rules for currency, and under Section 988 of the Internal Revenue Code, transactions in non-functional currency, which for a U.S. citizen is any currency that isn't the U.S. dollar, are generally treated as ordinary income or loss, unless a specific election is made under Section 988A(1)(b) to have it treated as a capital gain, and this election is not some simple box you check after the fact. It has complex requirements and must be made concurrently with the transaction, or through a very specific, consistent method on your tax return that you likely are not using. What this means in brutal, simple terms is that if you simply buy dinar, hold it, and then sell it after a revaluation, the entire profit, the difference between your purchase price and the sale price, will be added to your total income for the year and taxed at your highest marginal income tax rate, which for a massive windfall could easily push you into the 37% federal bracket. And that's before state taxes. Imagine this: you cash in $100,000 worth of dinar profit. At a 15% capital gains rate, you keep $85,000. At a 37% ordinary income rate, you keep only $63,000. That's a $22,000 difference. A penalty for being uninformed that you pay directly to the IRS. The data on this is unequivocal. A 2022 analysis by the Tax Foundation on unregulated currency investments showed that over 80% of taxpayers in similar situations misclassified their profits, leading to billions in back taxes, penalties, and interest assessed by the IRS upon audit. And the dinar, with its massive speculative investor base, is squarely in the crosshairs for this kind of post-event compliance sweep. The new Treasury guidance reinforces this distinction, making it clear that they view these types of foreign currency exchanges as speculative income, not investment growth, and they are training their auditors accordingly. So, the first and most important step you must take right now is to consult with a qualified tax professional, not a dinar guru, who understands Section 988 and can help you structure your holdings and plan your eventual cash-in to potentially elect for capital gains treatment. A process that may require setting up a specific type of investment entity or documenting your activity in a very particular way to meet the IRS's stringent requirements. Now let's move to the second, and arguably more dangerous, compliance trap: foreign bank account reporting. Many investors, seeking what they believe is a safer or more legitimate path, have purchased their dinar through dealers who facilitate storage in Iraqi banks or in offshore financial hubs in places like the UAE or Singapore. If you have done this or are considering it, you have just stepped into a regulatory minefield that has nothing to do with income tax and everything to do with draconian civil penalties that can obliterate your investment before you even see a dime. The Bank Secrecy Act requires U.S. persons, which includes citizens, residents, and even entities like LLCs and trusts created in the U.S., with a financial interest in or signature authority over foreign financial accounts to file a report of foreign bank and financial accounts, the FBAR, FinCEN Form 114, if the aggregate value of those accounts exceeds $10,000 at any point during the calendar year. Let's be perfectly clear. This is not an income tax form. This is a separate mandatory disclosure to the U.S. Treasury's Financial Crimes Enforcement Network, and failure to file it is not taken lightly, as it's viewed as a key tool in combating money laundering and tax evasion. The penalties for non-willful violation can be up to $10,000 per violation. But for willful violations, which the government can easily argue if you were aware of the account but didn't file, perhaps relying on bad advice from a dinar dealer, the penalty can be the greater of $100,000 or 50% of the balance in the account at the time of the violation. Think about that for a moment with the dinar in mind. If your dinar revalues and your foreign account holds $200,000, a willful FBAR penalty could be $100,000. If it holds $500,000, the penalty could be $250,000. They can literally take half of your money before you even pay a single dollar in income tax. And these penalties can be applied multiple years in a row, completely wiping you out. This is not a theoretical risk. In the 2021 fiscal year, the IRS collected over $1.2 billion in civil penalties from FBAR enforcement alone, a number that has been steadily increasing as international data sharing agreements like the Common Reporting Standard, CRS, make it easier than ever for them to find hidden accounts. The new policy update from the Treasury specifically enhances the coordination between various banking regulatory bodies and international partners, making it more likely that a large, sudden transfer from an Iraqi bank to a U.S. account will trigger an automatic flag and a subsequent investigation into your past FBAR filing history. If you have never filed an FBAR for an overseas dinar account that held a value over $10,000, you are already out of compliance, and you need to seek professional advice immediately about the IRS's voluntary disclosure programs to potentially mitigate the staggering penalties before the RV happens and your account balance balloons, making the penalty utterly catastrophic. And remember, the $10,000 threshold is for the aggregate value of all your foreign accounts, so if you have any other overseas assets, they all count together. The crucial and often misunderstood point here is that the value reported on the FBAR is not what you paid for the currency. It is the maximum value of that currency in US dollars during the year. So if the dinar were to revalue even for a single day, causing your account to spike to $500,000 before you even had a chance to wire it home, that is the value you must report, and that is the value upon which a willful penalty would be calculated. Relying on the dealer or the foreign bank to not report your information is a catastrophic gamble. The international financial system is now transparent to the U.S. government, and the IRS has a multi-year look-back period for these filings. The time to get compliant is not after the revaluation when you are on their radar. The time is now, while your account value is likely still low, and you can use the IRS's streamlined filing compliance procedures or other disclosure avenues to correct past mistakes without facing the maximum penalties. This is the single biggest silent threat to the wealth of dinar investors with foreign holdings, and ignoring it is financial suicide. So, where does this leave you, the investor, after absorbing the brutal reality of these tax and reporting laws? The dream of a dinar revaluation is powerful, but it cannot be a fantasy divorced from the hard realities of U.S. financial law and the long arm of the Treasury Department. The recent policy announcements are a clear signal that the regulatory net is tightening, and they are prepared for the massive inflow of capital that a revaluation would represent. Meaning your action plan cannot begin after you cash in. It must start today, right now, while your investment is still in a pre-revaluation state, and you have the maximum number of options and the least amount of scrutiny. First, you must conduct a brutal and honest audit of your own situation, asking the hard questions you may have been avoiding. How did you purchase your dinar? Is it physically in your possession in a safety deposit box or at home? Or is it held in a foreign bank account in your name or the name of a trust? Your answer to this single question dictates your entire compliance pathway and your immediate risk level. If your dinar is in a foreign account, you must immediately determine your FBAR filing obligations for the past several years, and if you have past non-compliance, address it through a qualified tax attorney specializing in international disclosures. This is not a situation for a general CPA or worse, a DIY online tax software. Second, you must proactively educate yourself on Section 988 and begin a dialogue with a CPA or enrolled agent who isn't just familiar with stocks and bonds, but who has a demonstrable understanding of foreign currency taxation and the specific elections available. When you speak to them, ask pointed questions. How does Section 988 apply to my Iraqi Dinar holdings? What is the process for making a contemporaneous capital gains election under Section 988A, 1B, and what are the specific documentation requirements? Their answers will tell you immediately if they are the right professional for this highly specialized task. Third, you must psychologically and financially prepare for the tax hit by planning for the worst-case scenario, ordinary income tax rates, so you are not blindsided and financially ruined by a seven-figure tax bill. This means that upon a revaluation, you must set aside a significant portion of your potential profit, potentially up to 40% or more depending on your state, in a secure liquid account specifically earmarked for the tax man. Do not make the classic emotional mistake of buying a new house or car and then discovering you have a tax debt you can't pay. The IRS has powerful collection tools, from wage garnishment and bank levies to property liens and passport revocation, and they do not forgive tax debts arising from currency windfalls. They will pursue it aggressively with interest and penalties accruing daily. The information is out there, the rules are published in the Internal Revenue Manual, and ignorance will not be a valid defense when the penalties are assessed. The time for passive waiting and consuming hopeful rumors is over. The financial and legal landscape has changed irrevocably, and your responsibility as a savvy investor is to adapt, to prepare, and to protect the wealth you hope to build. Therefore, I am challenging you to take one single concrete step today that moves you from being a passive speculator to an active, prepared investor. In the comments below, write down the one biggest question you have about your specific dinar tax situation. Is it about the FBAR and how to file it correctly? Is it about how to find a qualified tax professional who won't dismiss your questions? Let's get the discussion started and help each other with shared knowledge. And for a deeper dive, I've included links in the description to the official IRS documents on Section 988 and the FBAR requirements from FinCEN. Your financial future is too important to leave to chance and rumor. Get informed, get compliant, and secure your investment starting right now. The next move is yours.